a lot of retail locations are struggling. What's the future of Foot Locker going to hold? Even if they close down all the stores that suck for them, they can still make money. Here's why they fell so big. All right, guys, Foot Locker reported last week they lost 20% in one day. Today, they're down another almost 9% during the day. Let's pull it up in our software. Yeah, they were down 8.5% today. Big drops. Look at this chart since 2015. The last time it was this price was around 2013 or 14. Guys, a lot of retail locations are struggling, right? Here's why they fell so big. Here is their actual earnings release. Total sales decreased 11.4%. Comparable store sales decreased 9.1%. What does that mean? It means stores that have been open for 12, 18 months, whatever their definition of same store sales is, down 9.1%. That is not good. That is not good at all. EPS of 38 cents. They lowered their 2023 sales and earnings guidance. They just announced a new CFO. Guys, when COVID hit, I thought Foot Locker was very, very attractive. So after the COVID hit, for some reason, I was very interested. The stock fell a ton, but if you look right here, the stock fell as low as, and I had the stock at one point. Let's do a 5-year number. It's easier to look. It was down to 16 bucks. I owned the stock at some point in this period, but I got taken away from me by covered calls somewhere around here. So for a while there, I thought I missed the boat, and I don't know why it's fallen, but it must be some negative sentiment here that's causing that to happen. But look at this drop last week. Look at this drop last week. And that's the thing I want you guys to understand. I bought it around here, wrote it up a little bit to here, sold it here, and then felt stupid here. But I was like, I got to stick to my plan. And my philosophy on investing has changed drastically. I've decided I want to buy larger, more stable companies with stable cash flows that I can get at a small discount. I'd rather make less money, less return by buying companies that are going to be around for a long time that I have to do less work on. Foot Locker was a short-term play. If you're interested in Foot Locker now, it is a short-term play. The question is, what's it going to be? What's the future of Foot Locker going to hold? Comparable store sales dropping 9.1 is bad. Gross margin. That's literally revenue minus cost of goods sold. What's cost of goods sold? It's the direct costs associated with creating or selling a product. So it's before all overhead charges, before all SG&A expenses, sales, general and administrative expenses. That's what gross margin is. To be down 400 basis points is large, because their current gross margin last year was 32%. Okay, let's take a look here. Let's see here. What's the total net enterprise value? Okay, a lot of leases in there, I'm sure. Store base update. During the first quarter, the company opened 13 new stores. Okay, so they're opening stores. Does that mean they think there's still some markets to hit? Remodeled or relocated 18 stores and closed 35 stores. All right, I like that. Let's start closing off our stores that aren't doing well. Because guess what? Foot Locker could become a great place like Dick's Sporting Goods, where you can go to dicksportinggoods.com. Don't make the mistake that I made years ago when I went to a different website for Dick's Sporting Goods. And that was completely by accident. As of April 29, 2023, the company operated 2,700 stores in 29 countries, North America, Europe, Asia, Australia, and New Zealand. In addition, 163 franchise stores were operating in the Middle East and Asia. That's pretty impressive. Okay. Updated guidance, sales change. They're now guiding down 6.5% to 8% versus 3.5% to 5%. Comparable store sales decline. Let's see here. Square footage change, that's good. Okay. Their SG&A rate. Let's see anything big here. Interest charges are up. Makes sense. Non-GAAP tax rate up slightly. That's kind of weird. And they're expecting non-GAAP EPS of $2 to $2.25 versus $3.35 to $3.65. That's a big drop. But the stock is currently at how much? $27 a share. All right, so let's check out the 8 pillars on Foot Locker. Wow, didn't realize this. Look at that. 5 PE, 5.5 price of free cash flow. Okay, so guys, remember, a declining company can still be worth something. Just remember that. Just because something is, I just saw something on Twitter the other day, right? That a value play can only occur with increasing earnings. That is not true. That is not true. I'm not saying that all companies are declining are a value play, not at all. But every investment is the present value of all future cash flow. And even if that cash flow is declining, it can still be worth something. As an example, hypothetically, if you had a business that had no debt and had no cash, let's say, but you knew for the next 5 years before it closed, it was going to make $5 a year. That's $25 over the next 5 years. That is worth something to you. Is it worth 30? No, because it's going to go to zero in 5 years, as I just said. Is it worth 10? Well, yeah, you'll put 10 bucks in, you'll get 25 out in 5 years. That's pretty good. There's somewhere in there where the value is worth something. If it's going 5, 4, 3, 2, 1 in terms of earnings, that's still worth something. How much is that? 15 bucks in revenue? Sorry, in profit? That's worth something. So the question here is, has this gotten so stupid low that even if they close down all the stores that suck for them, they can still make money and still provide a return for their investors? Maybe so. They've bought back a ton of shares. Look at that. Their dividend is large. Their dividend is very, very large, 5.5%. Now, the question becomes, should they pay a dividend? I imagine if they cut the dividend, the stock will plummet. But if they're able to stabilize their cash flow and make $300 or $400 million a year in free cash flow, and use that to buy all their shares back as they're selling for 5 times earnings, you're going to see a lot of great returns for their investors. Why? They're going to decrease the number of partners they have. And hypothetically, let's say earnings stayed the same and cash flow stayed the same for the rest of the time. If they use all that money to buy back their shares, and let's say they went from 93 million shares down to 10 million shares, now all of a sudden you'd be splitting 342 million among 10 million shares. That's $34 a share. Is a company that generates $34 per share going to be selling for 27 bucks? No, you get it back in less than a year. That's how you drive the value when PE and price to free cash flow are low. You buy back shares to increase the split that other investors get of the revenue and of the earnings, revenue, and profit, and the cash flow and everything. That's the key. But remember, there is debt on this company, a lot of capital leases. So look right here on liabilities section of the balance sheet. Long-term capital lease obligations is $2.7 billion of their $3 billion in long-term liabilities. It's a big chunk because they're all in locations. Now they're starting to do a lot more strip malls, but there's all leases there. The question is, they're going to use this opportunity, and you can go in their 10K and see how many leases are up in what years. You can literally look at that in their 10K. And on our software, for $1 a day, annual reports, click at the bottom, and it goes right to the Foot Locker. Hit, boom, 10K annual reports, it pops right up. Let's see if we can find lease. Let's see here. Our properties consist of land, lease, stores, gross square footage, blah, 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 blah. Let's see, lease. Oops, let's go back up. There was a big chart there. Nope, let's still go down. See, that's the thing. You have to scan these things, and you'll be able to see like when their leases are up, but it'll allow you to determine what's that cash flow looking like. Because I guarantee you, Foot Locker is going to look for any opportunity to close any bad locations the second the leases are up. They're going to say, listen, this thing doesn't make money, it loses money, or doesn't make enough. Let's get rid of it. Consolidate some. 2,700 stores is a lot of stores. So I think they need to be focused. What I think I'd be interested in is, how are their online sales doing? Online. Let's see if there's any online breakdown. Interesting. We use our omni-channel capabilities to bridge the digital world and physical stores. Buy online, pick up, buy online, and ship. See, I want to know how much was online. Interesting. Let's see if I type in digital. I need to find digital with a. So digital advertising expense was down last year, but they're not showing us digital revenue. I don't like that. Why are they not showing us digital revenue unless I'm not paying attention to something? But here are all their locations and the breakdowns here by year, since last year actually. But the remodels, okay, so this is the thing to understand about Foot Locker. It's potentially a value play, but it's literally gonna be one of those things where you have to really dig into it because there's a lot going on there. There's a lot of locations. You gotta figure out, look at Bed Bath & Beyond, they went under. Am I saying Foot Locker's going under? Absolutely not. I love Foot Locker still. I still like going to Foot Locker. Do you, Nick? No, Nick does not go to Foot Locker at all.
They didn't stop retail sizes at size 13.
Oh, they stopped. Well, Nick's huge. He has a size 14 feet. But they did announce that Nike was going to pull back some of their gear that they're sending to Foot Locker. That's going to affect the business. You got to decide if that's the right play for you. Okay? So guys, let's go look and see what this company might be worth based on our stock analyzer tool. So I'm going to do a 5-year analysis because I wouldn't be shocked if they're not around in 10 years. So let's look at 5 years and see if we can figure things out. And I'm going to go low, middle, and high on all of these things. And it's going to take let's just go crazy here. Revenue growth, -10%, -5%, and let's say they keep revenue the same. Profit margin, 3, 4.5, 6. I'm going to do the same thing for free cash flow. PE, I'm going to go with 5, 8, and 11. And same with price of free cash flow. And guys, again, I'm throwing at the hip here. Now, for my desired return, Guys, I've beaten this up a lot. Negative 10% revenue growth a year for the next 5 years. That doesn't mean 50% drop. It means start at 100, you go to 90, 81, 73, 66, and then 60. So it's about a 40% drop roughly. Probably a little less than that. Okay? 40% drop in revenue. We're gonna hit the analyze button. Well, I did desired return first. So as it's declining, I want a big return. Let's say here 14, 17, and 20%. Because as I go higher and make my higher assumptions, I need a higher desired return. The more return I get, the less the price. Because the less I pay for something, the more it makes me as a return on my money, right? That's the key there. Hit the analyze button. All right, a low price of 11, high price of 41, middle price of 23. All right, guys, a lot's changed in this company since I looked at it 2-3 years ago, and that's the reason why you need margin of safety, because I wasn't expecting 10% drops in revenue, 5% drops in revenue year to year. So guys, that's Foot Locker. It's a good exercise in terms of how to look at businesses, especially potentially declining businesses. So thank you very much for your time. I appreciate it. Take care.